the slow uptrend in the market is still a result of this strong reversal signal, the bullish flutter kicker signal, still making the top of this wedge formation a likely target. Once it gets there, we're going to be in the overbought area. But we'll be able to see whether they decide, or I say they, the market decides to take profits at that point, or if it goes through, we now may be breaking out into another wave to the upside. The NASDAQ actually got right to the top of this channel, but didn't really sell off too hard, still in an uptrend. So we want to see if this can break out above this level. Once again, you can see the wedge type formation, and that if they break out, wave 3 could be another strong 3 months of bullish sentiment in the market. Knowing that the market's in a slow uptrend allows us to take advantage of patterns that we can see breaking out, kind of a slow curve. And notice how this had a doji sandwich that brought you right back up to the resistance level that our recommendation on WLH was based upon, that if it opened positive today, now there was a good prospect we're in wave 3. Wave 1 right here, wave 2, and then the doji sandwich bringing you back up above the T-line. And at the breakout level, that positive open told us we could be buying immediately, that now there's a new investor sentiment in that trend. And patterns like the doji sandwich and Roku told us that if they started trading this one positive today, doing the doji sandwich, remember, a doji sandwich is a big day, a doji, then another big day, this day right here being the same magnitude as this day right here, with the doji sandwiched in between. This is a very easy day trade or swing trade recognition of more upside based upon the very simple doji rule, that if it opens positive, the probabilities are it's going to trade positive. Additionally, notice where this was all occurring, right here at a level that everybody else was watching. We could see immediately, or very early in the trading, that this was going to continue its uptrend. Because we know what human nature does, it allows us to take advantage of the results of expected signals or patterns. So we knew the result of a doji sandwich, especially right at a breakout level, like the 50-day moving average, was a good place to be either buying or continuing to hold your positions. And Crocs was one of our recommendations based upon the pattern and the exact breakout level. We could see what started wave 1 was a bullish engulfing signal right off the 50-day moving average. We could see where the selling was starting. Doji, hanging man, selling. Time to take profits. Then we could also see that the T-line was acting as a support level. So if you closed out the position here, you could either be buying back in this area, back up above the T-line with the expectation of breaking out, or more conservatively, you could have been buying on this day, knowing that this was breaking out through this level, giving you a wave 1, wave 2, wave 3. Because we know what the results are of signals and patterns, because that's what the results have been for hundreds of years based upon investor sentiment, it allows the candlestick investor to take advantage of price moves at the most appropriate times. That'll be it. We'll see you in the chat rooms.